you've made a couple references to Keynesian economics. You're talking about John Maynard Keynes, the famous economist who advocated expanding money
Just
supply,
print money.
government involvement.
Worry about it later.
Yeah.
It's fine. The government can take care of everybody.
Well,
it's just not true.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, we'll get into the news as always, but first, you're on the road a lot, okay? So that's not surprising, and you send us messages from various conferences and so forth, but this one was unusual. We get the team gets a picture. So CNBC, we often reference stories from CNBC. We've got a few in the outline for today. CNBC is covering something live in Beverly Hills, California, and the main speaker is in the frame, but in the background there you are. You're not photobombing. I mean, you're not mugging for the camera. You're talking to a couple other people, but that is you in the background of the shot. The people watching on YouTube can see it. What was going on out in Beverly Hills, California?
So it was the annual CAS Alts Summit, which means alternative investments. And CAS has built an amazing platform that we have taken advantage of for our accredited and qualified investors. That means people that have at least $1 million in liquid or $5 million in liquid investable assets can get access to investments that not everybody can. And now President Trump is pushing to get more people access, which I sort of agree with some caution, but alternative investments are those that are not typically liquid, Chip, like your simple main three asset classes are simply going to be like cash or cash-like things like money markets, stocks, and bonds, right? So those are the makeup of the majority of Americans' portfolio that have investments. Alternatives get you into exposure in other areas. It could be commodities, it could be long short funds, hedge funds, private equity, private credit, right? So that's just bonds for companies that are not publicly traded. It's really important to understand why this is so important. Chip, 81% of the companies that have a valuation today in America over $100 million, 81% of them are not publicly traded. So if you do not have access to these markets, you're leaving a wide swath of the potential to earn and invest for your future off the table. And so there is a huge push. And the picture that you showed has got the CEO of CAS, his mission is to bring this to the masses. It's kind of been mainly in family offices and for the very high affluent. We've been trying to bring this down to everyday customers, but there is hope that you would literally have to take a test. So if you didn't make the qualification of, say, $1 million liquid, there's an income qualifier, $200,000 for a single, $300,000 for a couple that you can qualify. But even if you didn't meet that, we're trying to get it where you can literally take a test. You understand the inherent risks of non-publicly traded investments, and you get access to these type of investments.
Well, is that the issue? Is that why access is limited? Because it is a riskier market?
It's not a riskier market. That's the misconception. But it's not it's an illiquid market. In other words, you pay
not as flexible
to have daily liquidity. You actually pay a premium. So the same assets in equity that are publicly traded versus privately traded, it's about 175 basis points or 1.75% per annum additional gain in the private markets because they don't have to worry about you cashing out every day, right? Which means they can run their companies differently for better growth long term. The downside is, we just said, is you can't just sell that asset instantly and liquidate it every day. So therefore, it's not appropriate for except a portion of someone's net worth. So if we have somebody, let's say, has about $2 million, Chip, it would be very appropriate for them to have maybe $250,000 in these type of investments, just giving you a rough estimate number. Somebody has $25 million but lives on normalized income, and we have clients like that as well. It's very common for those families north of $25 million in net worth to have over 50% of their assets in non-liquid investments, commercial real estate, private hedge funds, private equity, private assets, infrastructure funds, et cetera, that are going to pay them sometimes really nice returns, but they have to be willing to let those dollars go. I've talked about all the time. There's alternative investments that I personally use, and you can now get access to, because of these investments, things like Major League Baseball, right? We just had probably the greatest performance in baseball history with the LA Dodgers, Shohei Ohtani, the game that sent him to the World Series, and the guy pitched 10 strikeouts, I think 7 innings, right? Mm-hmm. No runs given up, and then hit not 1, not 2, but 3 home runs, one of them out of the park. I mean, very Babe Ruth-esque. So, but owning that, we talked about the contract, thought, wow, $750 million, remember his contract and how he used tax deferral on it, right?
Yes.
They made the money back on his contract in 9 months. 10-year contract. They made it in 9 months because of how popular he is in Asia, right, in the Far East, and the rights they have out there. Anyway, so you'd want access to these type of things, right? They're making pretty good money hand over fist, professional sports. Those are the type of investments that you can get through these alternative platforms. So anyway, that's why I was in Beverly Hills, and I'm just I'm not a big spender, Chip, but I will tell you, I had to pay $95 for a couple of eggs over easy bacon, coffee, and toast one morning at the hotel. That I don't want to tell you what the price tag of that hotel was per night, but I didn't have to pay it. I was invited. I was invited guest on the conference, paid for the hotel, but I did have to pay for that breakfast.
Well, the message you sent along with the shot here was reports of handsome man spotted in the background on CNBC.
That is a good-looking dude.
All right. Hey, I don't want to spend too much time on this because the whole second segment of today's show is going to be dedicated to this topic. But Mike Schudel is going to join us because we have another round of proactive exit and tax planning for entrepreneurs coming up. You've often called yourself a serial entrepreneur. So just quickly review for folks, where did this class come from and what is the focus?
Well, it's been born out of my own experience, and I've started over 40 companies, and not all of them have worked out. But
Tom Osborne said you learn more from the defeats than you do from the victories.
Absolutely, your failures teach you way more. Yeah. And so, but I understand what risk capital means, what it means to risk. I mean, every year running this company, I have to make a pretty big capital commitment for my own personal net worth to make sure the salaries are paid, et cetera. So that's what it's like to run a business. And so what we've done is we've helped. This class is part psychology, part understanding how the tax laws work, and then thinking about the future of the value of your company and how to increase the value of it. And we have 4 different CEPAs available here, which is Certified Exit Planning Advisors. We have one that's an attorney. We have one that's an advisor, one that's me, that's the entrepreneur, and one that's a CPA. So we come from it from 4 different angles when we sit down and plan with clients how to grow and then eventually exit their business in the most tax-efficient manner. Great class.
More on that in the second segment when Mike Schudel joins us. All right, David, into the news we go. Let's spin the globe and stop it on the other side in the Far East. Here is the CNBC headline, Japan makes history as Takaichi set to become the country's first woman prime minister. Tsunai Takaichi, I guess some are calling her Japan's Iron Lady in this super patriarchal society of Japan. She is the first prime minister. What is your read on her? And then we want to know, how did the Nikkei react, the Japanese markets?
So you understand, she's on a conservative party, right? And in Japan, you don't have a 2-party political system like we have here. There's basically 8 different political parties, but 5 of them kind of have enough
parliamentary system.
Yeah, so that they have to make these coalition governments. And so labor, it's just like in England, you have to kind of make some compromises to put together a coalition so you can move an agenda forward.
Find a
she's
majority,
fiscally very conservative by her nature. However, she's out there trying to follow up because Japan, the world, when I was in school, when I started college, Chip, everybody thought Japan had the world figured out. Getting an MBA studying Japanese economics in the mid-'80s was the thing to do. Northwestern University, Brian Westbury went there. And he talks about that's all they talked about. Japan had figured it out. Turns out they didn't have it figured out, and they've been doing Keynesian economics for 4 decades now, just printing money. We had Abenomics, right? We talked about the former prime minister just printing money, and they had it at such a low interest rate they could kick the can almost indefinitely. Well, those days are over. Interest rates in Japan are spiking. Now, spiking there is 3% because they were negative for a while and 0. But so now she's advocating, being a conservative, for keeping interest rates low and floating more debt because she has to in the position she is. So the markets over there kind of were positive in the initial reaction, then were kind of muted. It's going to be a wait-and-see approach. But Japan has a debt tsunami. In fact, they're the 2nd worst debt-to-GDP country in the world right now, Chip. Sudan is number 1.
All right. Well, let's spin the globe back to the West and let's land in Europe for a moment. You sent the team a chart of, here's the headline. Capital gains tax receipts fall 10% as wealthy quit Britain. Raise taxes, get less tax revenue.
They have what they call a nom-dom tax. That's literally the name of it, a nom-dom tax in Britain, where they're increasing tax rates on the sale of assets, capital gains, so business owners typically. There's not a lot of land that gets sold there because land is owned in large swaths already by lords and lordships that's been passed down literally ancestral generations. but basically businesses or assets of businesses are what would get sold. Well, they increase the rates, Chip, and guess who's got a debt problem? Britain. They have a massive debt problem. We were just talking about Japan. Same thing. They're in the top 10 of world's worst debt violators, debt to GDP ratio. So when you increase tax rates, the wealthy, guess what they can do, Chip? They can vote with their feet. So they can pick up their company and just transition it to, and guess what? Didn't we just see this here? Delaware, right, is losing corporations to Texas and Nevada because of the Elon Musk case, right? Because they kind of overreach of regulation, overreach of taxation, and people will just move their business elsewhere, and you won't get anything.
New York City might be about to get a crash course in that lesson.
I can't wait to start talking about that after November 4th if that actually happens, which is highly likely right now. But anyway, this is just a simple lesson in economics. Keynesian economics were just theories, yet we have multitudes of academia. We have over 600 PhDs working at the Federal Reserve here that follow this absolute nonsense. And so, I hope the government shutdown gets a little bit longer in the tooth, because maybe we'll start to have real conversations that need to be had.
You've made a couple references to Keynesian economics. You're talking about John Maynard Keynes, the famous economist who advocated expanding money
Just
supply,
print money.
government involvement.
Worry about it later.
Yeah.
It's fine. The government can take care of everybody.
Well,
it's just not true.
And this business with the wealthy voting with their feet, as you said, it's not a partisan thing. It's an economic thing.
It's that simple.
Trump, Reagan, JFK. Tax cuts ultimately produced
led to economic expansion every single time we've done it.
Yeah.
You can grow your way out, but you have to have a reasonable understanding of how to do it.
Up next, Retire Smart financial advisor and certified financial planner Mike Schuettel will be very busy in the near future as a presenter for 2 different events, providing vital information for our clients and the general public. We'll visit with him next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Mike Schuettel will be working even harder than usual the next few weeks, and it's his own fault. It's the price he pays for being not only a licensed financial advisor trained in the law, but also a certified financial planner and a certified exit planning advisor. He brings it all to bear in 2 classes that we have coming up. David, please welcome multi-degreed and multi-talented Mike Schuettel.
Hey, thank you, Chip. Yes, joining me in the studio once again, we have our resident authority on all things of exit planning and estate planning, and helping business owners both plan through their the working years of the business and then eventually the exits, especially when it comes to the estate planning. Mike, thanks for joining me in the studio.
Happy to be here.
So along with leading our class on tax and estate planning, which you've led for many years now, you have helped pick up the mantle on our business owner class, proactive tax and exit planning. We've got one of those coming up in November. Well, you went and earned your CEPA. So talk about that for just a moment.
Yeah, that stands for Certified Exit Planning Advisor. And what that basically conveyed to us is the knowledge to help entrepreneurs who are in the growth phases, just getting started, through the middle phase where they are well established and starting to think about passing the business on to the next generation or selling it to an outward buyer. And last of all, helping those people make that transition, sell their business, cash out what they worked a lifetime to build.
Yeah, and there's so many different strategies that can be implemented. Let's start with that business that's still in the early phase. Could actually be a business that's been running 10, 15 years, but has never kind of gotten over the hump of really feeling maximum profitability, et cetera. They grind out, they make a living, they feed their families, but they don't know all the strategies, especially within the tax code, to understanding. I mean, Evan, our CPA, teaches the class with you and I, and we've talked about it. 40% of the business owners that we meet with are in the wrong structure, the wrong entity to begin with, and that has massive implications not only on asset protection, something you know really well, but taxation of their current income. And of course, if you can use some of those strategies to increase the margin, increase profitability, by using the tax code to your favor, well, that increases the multiple that you would get an exit, right? If you did decide to sell in the future date. Right,
absolutely. So helping out those people that are just getting their business started, one, we want to make sure there's some defensive measures in place on the owner and their key lieutenants, their most valuable employees. Just because typically if you unplug these people from the business due to some life event, the business is probably going to fold very quickly.
No, I mean, I actually just met with a business owner in a construction business, And one brother kind of runs it. One brother is really the owner. The other brother is the operator. And they have about 6 key people. And just that. And one of the discussions we had is, well, have you put anything in place to protect these 6 key people, both if you had to replace them and to entice them to stick around long term? And nothing was in place. And I just explained a couple of strategies. So one of the things you can do is simple key man insurance, right?
Yep.
So you could have some insurance in place if, gosh forbid, if somebody were to pass away, a key member of their crew, you're going to get paid a death benefit, which could be used to go recruit somebody of the same talent, et cetera. Right? Nothing's perfect, but I mean, it's just there's so many things, and these things are not very expensive to put in place.
No, that's one of the nice things. This is not a difficult process. It's not a very lengthy process, but it needs to be done right. Just calling up your local, property and casualty State Farm person, not saying anything bad about those entities, they are not going to know how to put these particular defensive measures in place. You need somebody that understands the risk of your unique business and to tailor fit the key person, all those defensive measures.
Well, and the other thing is you're pretty good at helping them understand. There's also, you can flip the script. You could put things in place, plans in place that we call them kind of platinum handcuffs. You can kind of keep the key people tied to the business. In other words, they're getting their pay and their incentive comp, what you're paying them today, all their benefits, but there's some deferral comp that you can set up these plans that are tax advantageous to the business owner, but they become really advantageous if the employee succeeds at their job and sticks around to an end date, typically age 62, 65, something like that, right? So you're kind of ensuring their loyalty to keep driving that ship forward.
Well, yeah, if they're this talented at helping you grow your business, guess what? Pretty soon they're going to get the attention of other people in your industry, and they're going to come knocking.
Well, A companies hire A players, and
Absolutely.
A players typically already have a job. That is so important to understand. So it's exactly right. Recruiters, and we use them in our industry, let's face it. I got you through a recruiter, right? Over 5 years ago, I had a recruiter find you for me. So we companies are doing this, and the labor market is tightening. So I think that's really a key point right now. You need to make sure that your key employees are being taken care of, and they're understanding the transition plan if there is one in place, if that's something you're planning. So let's just talk about there's only really 5 ways somebody can exit a business, right? Unfortunately, the first 3 are the triple Ds are not healthy ones to talk about: death, disability, or divorce, right? And we've seen all 3 come across our plate, so to speak, and it's not fun, but we can pre-plan for any of those kind of situations. But what we'd rather do is plan for the other ones where, one, it's another bad one. It's bankruptcy. Unfortunately, your business is run into the ground. So if we can get in plan ahead of time, we can usually save a business that has really good revenues, just really bad bottom lines. And that's, again, using the tax code to help them get back to profitability. But our favorite way is the actual, hey, we decided to sell it, a planned exit. And there's a myriad of ways. You could be selling it to key employees. You could be selling it through like an ESOP. By the way, that could potentially be tax-free.
Yes.
We could be selling it to what's called private equity firms that buy they do what's called roll-ups. I'm helping 2 customers go through that process right now. And so, or we can just sell it on the open market. And the choice you would make on that would depend on a lot of factors. It's not just, hey, how much do I get for the price tag? How much do you walk away from that transaction with, right? That's what we want to talk about. How much do you keep?
And that's what most people have in mind when they're thinking about the exit. But actually, let me back up the train for just a minute, a little bit further. When somebody's just getting traction with their business, the bills are getting paid, there's predictable cash flow and all that stuff. One thing that we see a lot with these businesses that are just really getting momentum is the owners have a very difficult time letting go of certain aspects of the business.
I don't know what you're talking about.
If only I could think of somebody like that. But I actually want to talk about you with that in just a second. And I get it. If you don't control it, if it's not in your hands, if it's not under your vision, then it's not getting done to your expectations. Well, if it's not something that you are specifically great at doing and it's not generating revenue, then you need to leverage that to someone else. And like you said, that could be getting a great accountant that makes sure you're in the right tax entity, because God forbid you're like, oh, I'll worry about that 5 years from now when I got more time and revenue. Well, then you're so complex and so pigeonholed into your current structure. Good luck ever getting out. So having the end game in mind, where we have helped multiple very successful multi-double and triple-digit $1 million exits, knowing the end game in mind is so much easier for us to meet you where you are at that earlier phase in the business, get things set up so that just you're able to grow into those shoes, so to speak, much more comfortably.
Well, let's pivot for a moment, because one of the entities I work with right now that's going through that process, it's not just a single owner. It's about 5 different shareholders, and they have varying percentages. So what they're going to walk away with is significantly different sums, like 7-figure different
Correct.
sums. So the planning we do for each one of those, which we're doing, and we currently work with 3 of 5 shareholders in the business I'm talking about. We can't disclose who it is, but 3 of the 5, and 2 get a check up here, 1's getting a check down here. But it's very different strategies used based on the dollar amounts of those checks, what they want to do with the proceeds, what their plans are, et cetera. And I always warn people, because I am a bit of a serial entrepreneur. Entrepreneurs like to be entrepreneurs, and they're like, oh yeah, you can tie my money up. I'm good. I've been successful. That's just so not true, right?
Yep.
You always have to have liquidity after the exits for the entrepreneur, et cetera, so they can understand what they want to do and give them the freedom, which is really what being successful in business is about. It's about freedom. Freedom, I mean, money is a great resource to have, and you're blessed when you feel like you have it, but it's just a tool, right? Really what you're trying to buy with money is freedom, time to do what you really want.
bet.
And like I always tell people, what is retirement? It's doing what you want to do when you want to do it. Then you effectively are retired. So
Well, I just want to hear from your own words, David, because when we get started, as you and I have that, humble beginning little office, we called it the closet, and now we are well on our way to being a $1 billion firm. You were able to leverage your time better, get the right people in the right seat to delegate those things that you were not inherently gifted at, that you were not able to draw a direct line from revenue to your efforts therein. Talk a little bit about how you were able to magnify the growth.
And I got coached, and and I always think entrepreneurs, they miss out on paying for coaching, and that's one of the things that like Evan does really well, is coach a lot of entrepreneurs. But when the coaches coached me to realize that it's not the best use of my time. My favorite place to be, and I mean, all the advice is in the conference room with our clients, and I don't get to spend a much time there anymore. I still do several hours a week, but and most clients understand I'm in the conference room for about 15 minutes when I do get to go in, typically for a high level strategy session or something. But that's just it. Is I've learned I'm better off. You were what we call proof of concept, right? So we trained you, and then the very next year, once we had you kind of up and running, I was, okay, concept works, it's scalable. What I've taught you and your background meshed well, and then we brought 2 more on, then a couple more, and we have well over a dozen advisors now, so we keep building that out because our mission is to help as many people as we can. And then it's understanding, there's an old saying, Jim Collins' great book, Good to Great, but in the book, he just talks about, get the right people on the bus, get the wrong people off the bus, and then make sure everybody's in the right seat. And that's something you have to learn to do as an entrepreneur. You may have great culture fits, but they're in the wrong job. And we've had many people, Mary, who's my executive assistant, my gatekeeper. If you want to get to me, that's how you better talk nice to Mary, right?
You better eat your Wheaties too.
But Mary, it took her 3 roles to find the right spot for her, right? And so it's the same thing. Entrepreneurs sometimes are putting a square peg in a round hole, right? And so understanding how to get the right people in the right positions helps your company run more efficiently. It takes a world of stress off the entire team, yet you achieve amazing results. So listen, again, we're running out of time here, Mike. When is this class so business owners can learn? It's a little bit of coaching, it's a little bit of proactive planning for now, and eventually for the exit planning in the right direction.
Yes, our exit and tax planning for entrepreneurs is coming up on Friday, November 7th. At 8:30 a.m. here in our offices in the Midwest Learning Center.
And I think we're going to have a little breakfast or donuts or something for you. You'll be in and out in an hour, a wealth of information, very fast, no obligation. But if you're an entrepreneur out there doing at least $1 million in revenues to your company, this would be a class you'd most likely want to attend.
Looking forward to seeing them.
All right, Mike, thanks for stopping the studio. We are out of time.
Yep.
Chip, what do we have next?
Up next, you have questions, David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, a few more questions yet from our September Speaker Series event. And the first one is about an economic term used in the presentation. Where did the term quintile come from?
Well, that just means 5. You're dividing by 5.
Latin,
so quintiles
quintus,
is Latin.
yeah.
Yep. So that's just 5. So basically, when the IRS analyzes our economy, they break it into quintiles. So the bottom 20%, the next 20%, the middle 20%, which is what Becky Swanberg in that presentation focused a lot of time and energy on, which is a lot of our clients, right? And then the next 20%, and then the top 20%. So when you swath that out, that's what she was referring to. So basically, just the middle of the road average Americans, what they've saved, what their income is, which is a lot of what we would call our Midwest millionaires and bread and butter retirees that we work with every day.
On to the next question. It's about bonds, David. Are government tax-free bonds a good tool for income in retirement?
They can be. The problem is you have to understand the liquidity provisions and how long do you buy a bond. So when you buy a bond at face value, $1,000, it's going to pay you an interest rate. Today, that interest rate is 4% on a 10-year bond. So basically about 4%. I'm just giving you round numbers here. So if you give them $1,000, they're going to pay you annually $40 in interest. So you're getting a 4% rate of return. If you hold that bond to maturity, Chip, in 10 years' time in this example, they will give you back your $1,000. And then, of course, you could buy another bond in it. Now, the problem with that is the 4% that you're getting today enough income? And the answer is almost always yes, year one of retirement. In fact, there's what's called the 4% rule, right? The idea that, so if you had $1 million, you could pull $40,000 in interest. The problem is inflation starts to erode your spending power. You're going to need $41,200 the next year, and then $43,000, right? And because of inflation at averaging about 3%, you're going to need more income every year. So the income from those bonds will not keep up. Therefore, it cannot be the only tool that you use. So the other problem is interest rates change the value of bonds every moment of every day. When interest rates go up, bond prices go down. It's an inverse relationship. When interest rates go down, bond prices appreciate. They go up in value. So if you understand this, you would have a laddered bond portfolio if you're going to use them. In other words, diversified maturities, 2-year, 5-year, 7-year, 10-year, 20-year, et cetera, right? So you would ladder them across different maturities because they're going to react differently to those interest rates moves. And you want to also make sure that your portfolio would have some sort of equities on the other side of it, something to grow to keep up with the inflation. So bonds can be used for the short term very easily, especially when interest rates are set higher at the moment, so you're buying at a decent interest rate. When I started my career, Chip, we had treasuries in double digits, and people would kill for that today. I mean, literally, could you imagine getting the federal government guaranteeing you 30-year interest rates at 13, 14, 15%? That's literally what was available when I walked out of high school, right? You could buy a U.S. Treasury. And on top of that, as interest rates came down over that 40-year period, those bonds appreciated substantially in value.
What's typical now? Like a half or a quarter of that? Or what?
Yeah.
What's typical in the bond markets
today,
now?
the average bond portfolio is going to yield you less than 3.5%, right? Because you're going to have some shorter duration in there. And on top of that, when the interest rates just moved up the last couple of years when they did, you lost about 8 to 10% in appreciative value. So you actually were negative on the return. So bonds, you've got to be careful, understand timing, when to use them in the portfolio. But you also need to understand, depending on what tax bracket you're in, you might want to slide out of government bonds from the federal government and into municipal bonds issued by a municipality in the state with which you live, especially if it's a taxable income state like we live in here, because you may have a higher tax equivalent yield. And we can calculate all that for you. But yeah, there's a lot there to understand, what you'd be want to look at. But with our debt spiraling out of control at $38 trillion, you may want to be really careful how much you're willing to trust the government on those bonds, right? Because governments will have to make some austerity moves. We've seen that in Europe already. I don't know if that's coming to the U.S., but it's something we're certainly paying attention to.
Next question, David, is about the Medicare penalty known as IRMA. This refers to income-related monthly adjustment amount. I think I got that right. Given the 2-year look back for IRMA limits, how much could we comfortably overshoot the 2025 limits without being affected in 2027? And when I first saw that question, David, I thought, that must be you must have meant 2026. And some of our advisors said, no, it's a 2-year period. It's a 2-year window with which you're working when you're evaluating this IRMA situation.
So it's a 2-year delay. So what happens to you in the tax year 2025 as we're recording this show? Whatever your income ends up being, okay, and it's not just your AGI, it's your modified adjusted gross income, and there's actually 6 versions of modified adjusted gross income, but the one that we look at is going to take into account even tax-free interest from these municipal bonds I was just referring. You're going to have to calculate part of that back in here. And if you go over the threshold, typically about $106,000 for a single filer and $212,000 roughly for a joint filer today, if you go over that threshold, you pay a penalty. And then there's more penalties coming behind that. So when you say overshoot, once you've overshot it, you are in the penalty. You can get exemptions from the IRMA penalty. Now, there's only a few things that qualify. We help clients all the time fill out the form. But if you have a change in income, you qualify. So in other words, the year you retire, you can usually file and get yourself exempted at least for 1 year. But if you do Roth conversions repeatedly, which we do for a lot of clients, that is not an exemptable outcome. And so you're going to pay for it. So in 2027, you would have to pay IRMA in this situation. However, you would, if you did the heavy lifting now, maybe you don't have to go so far and you never have to reach those thresholds in your future, saving you in the long run. Short-term pain for long-term gain.
Boy, the common theme here, get some professional guidance.
Yeah, absolutely.
Don't try to navigate these waters on your own.
People understand, like when we interview younger financial advisors, like, well, how many pieces of software do you use? And I'm like, well, we have about 8 or 10 that we touch based on what we're doing for clients, because there's no one piece of software that calculates all this accurately, at least in my humble opinion.
David, I'm going to hit you with 2 questions at once here about Roth accounts because they're in the same vein. The first one is kind of a general nature. What will prevent the government from changing the rules on Roth accounts to take more taxes from them? And then a similar question in a more specific, that was a little more specific. If you move dollars from an IRA to a Roth to reduce taxes later, isn't it possible they will add fees, taxes, etc. to Roth accounts later and we still pay high amounts? The common concern here is, well, what if they move the goalposts later on down the line when it comes to Roth accounts that are supposed to be tax? You pay the taxes up front on a Roth account, and it's supposed to be tax-free after that.
All right, so here you have to understand, where's the government go to get the money, the low-hanging fruit they see, right? And that is taxing your qualified dollars that you still have not paid taxes on. So I do not, yes, it's possible, right? Anything is possible with the government. But if you study legislative bodies, what they've been able to do when it's been challenged, in courts, et cetera, we have never, ever gone back and taxed a dollar that's already been taxed ever. It's much like double jeopardy, right? I don't think OJ can get tried for something many of us believe he may have done, right? Again, there's a rule called double jeopardy. It's the same principle. And in fact, 4 different states have tried this and failed at all 4 Supreme Courts in their state level. You cannot go back and tax something. Now, do I think they could change it? Yes, and I think they will. It's been proposed. But what they're going to change, Chip, is not taxing Roth dollars that are already there. They're going to increase taxes on dollars you're trying to get there, and they're going to limit the amount you can convert. It was not always unlimited conversions available. A Roth IRA was invented in 1997, but you had income caps every year if you could do a Roth conversion. They were very unpopular. 2010 was the golden year because it was the extension of the Bush tax cuts, and in that year, it was uncapped. You could do any amount of Roth conversions, and that year only, you actually got to take the tax bill, lock your rate in, and then spread the bill out in 2010, 11, and 12. But very few people did this because nobody was educating them like we were, or I was, even back in those days, to get dollars moved over. So yes, it's possible, highly unlikely.
A completed Roth transaction ought to be safe, but there may be other places around the margins
on
where
top
they could
of that,
try to get at you.
The Roth distributions in the future will not trigger those IRMA penalties we talked about, and they will pass on to your kids under current law, tax-free, where your IRAs will not. Huge, huge benefits.
Up next, Nebraska is back in the winner's circle in a national study about quality of life. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we were on such a great streak, Omaha and Nebraska for a while, and then there was a property tax study recently, and we were unfortunately in the top 10 on a list in which you don't want to be in the top 10 highest property taxes. But now we're back in the winner's circle. We're back on a winning streak. This is you shared this with the team from Wallet Hub, the happiest states in America. Wallet Hub ranked states on 30 key factors from mental health and productivity to income growth and unemployment. Let's see. Number 1 most happy was Hawaii. On this scale, Hawaii scored a 66, but coming in tied with Maryland for second at 64, Nebraska.
Yeah, and people have a great disposition here. I've talked about that for the 8.5 years I've lived here, and it's a wonderful state. There's no place like Nebraska, right? So, but yeah, this is good to get back on the good side of any of these surveys, right? That even despite the high property taxes, we have a friendly environment, and our cost of living is relatively inexpensive compared to a lot of the other parts of the nation. So, good news.
I was always amazed at you coming here from Florida we think of, oh, beautiful sunny Florida. You said, no, I love the change of seasons.
Oh,
I
yeah.
like
And especially now, the cooler mornings are getting
Yeah.
on. I walk my dog. I got to put on a hoodie or something, and I love the cooler seasons. In fact, I was chatting with somebody on the drive into the studio this morning about, when we'll expect our first dusting because, I moved here in 2017 and it snowed pretty heavily actually on Halloween that year. And
yes.
and so on 4 of the 8 years I've lived here, half the years we've got our first snowfall in October. So we'll see when we get our first one this year.
All right, back to the news we go, David. CNBC headline, U.S. budget deficit edged lower in 2025 as tariffs, debt payments both saw new records.
Yes, we actually had a surplus for the month, right? Which is, a good thing. Of course, the media doesn't really want to cover that too much, but the tariffs are putting revenues into the federal coffers. We have yet to see any real inflationary spikes from the tariffs. So we've talked about you do get a one-time upset in prices because of the tariff, but the next year the tariffs have already been in place, so they're not inflationary by nature. And so, but that's been the rhetoric that you've heard from the media outlets because they've been trying to downplay it. Again, I'm not saying I'm a huge fan of tariffs. I like free trade, but it also has to be fair trade. So anyway, well, a surplus is a good thing. We should all be cheering that. And if interest rates continue to go lower, that will help us do that more often because the federal debt that we're trying to cover right now is a little scary.
Well, and we still have this strange dichotomy, right, where at the grassroots level, the jobs market and the economy, still some worrisome indicators, but here's great revenue coming in from tariffs and so forth.
Yeah, we have a very K-shaped economy right now.
What does that mean?
So the slant line going up off the K is the people that are doing well that own assets in this country. They've been rewarded. Stocks, bonds, real estate over the last several years.
Yeah.
The people that don't own assets, the economy is not feeling good. Job market is less than it was. So they are struggling. So we have a very, very bifurcated society now. And sadly, this is what South America was like
That's not
in
good.
the 80s. No, we're losing the middle class. It's clear as a bell.
Yeah.
And so we need to continue to grow the economy to lift people that are in the bottom half of that K up, and we need to do it quickly.
K-shaped economy. All right. Well, people investing in ETFs are on the upstroke of that K in the economy. This is from the website Seeking Alpha. The headline is, ETF, these are exchange-traded funds. ETFs ride the wave higher as AMD surges on OpenAI deal. There's a lot of jargon in there, David. Break this down for us.
Yeah, it was an article, and in the article they listed the top 10 exchange-traded funds that happen to own AMD because AMD spiked massively on the day the news
Advanced
broke.
Micro Devices.
Yes,
that's
and
AMD.
so that's like a competitor to NVIDIA, right? So it's a chip company. And we were blessed that one of the ETFs we launched recently was mentioned in the article. So if you want to learn about that, make sure you would understand investment expenses, fees, and risks, et cetera. But you can go to smartwayetfs.com and learn about the products that we launched.
All right, David, here's a point that you have brought up several times recently, and we have another example of it right here. You sent the team a chart of loan caps. This is for we're looking at law schools here, specifically Santa Clara Law School. Well, tell the folks what's in the chart and why it caught your
lists
attention.
The tuition basically for the last 10 years of this law school. And just so you understand, when people applied for graduate level loans from the federal government, which were guaranteed by the federal government, you know what's
Guaranteed
strange, Chip?
student loan program. I participated in it.
No cap on the loan amount. So if this college or any other said, we're going to charge $70,000 tuition, they would guarantee the loan. Well, I mean, I will tell you, there's many people, even with law degrees, will attest the value wasn't there, at least on the way the student loans worked out on deferring all that interest on these loans because they're guaranteed. It's ridiculous, right? So they capped it this year at $50,000. Now, you know what's really weird, Chip, is lo and behold, the first school in the nation to publish their tuition for next year, it's $50,000 exactly. That's so weird, right?
Yeah.
In other words, Of course it is. So if it was guaranteed at $40,000, what do you think their tuition would be?
Right.
The same thing with healthcare right now. Get the government out of the way and the prices will fall. I think the institutions ought to guarantee the loans if the value of their degrees is such that the employees or that the graduates are going to go earn a good living. They should guarantee the loan.
Well, that was the point you had made before, that look at the two sectors with the highest inflationary pressure, healthcare and education.
Because the government
and that is
keeps
where the
their
government is
tentacles
most
so far
involved
into them both.
with subsidies.
Absolutely.
All right. This is, I guess, a bit of a public service announcement here, David. You sent me this story from Dexerto. AWS, this is Amazon Web Services. AWS crash causes $2,000 smart beds to overheat and get stuck upright. By the way, no connection to Retire Smart or Smart
And it's so funny. That's how I got it, though. You can set these things like Google Alerts. I sent Google Alerts out there. It tracks the word smart everywhere, right? And so I get all kinds of stories, and I just thought this was fun. AWS, the largest web service provider in the world, right, of services, and they had an outage for about 12 hours at the beginning of this past week. And, there was all kinds of carnage and things, websites that were struggling. But I just thought this was funny. Is your smart bed, which had heating in it, was stuck on hot, or some of them were stuck in a 45-degree angle because these are almost like Murphy beds that can go up and down for convenience in studio apartments. And people were stuck sweating it out in these beds. So just be careful what appliances and what smart devices you decide to tie to the web constantly. There's some unintended consequences. I thought it was kind of comical.
Well, that'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Financial advisor Mike Schutel has a Juris Doctorate law degree but is not licensed to practice law. Any statements and opinions are general information and not legal advice.